The following program is brought to you by Jack Miller.
It's Down to Business with Jack Miller.
Turn it around.
Forget what they teach you in school. This is real life. Not Wall Street, but Main Street. Our guests will answer your questions and provide you with valuable information. Stay tuned and join in the conversation. Follow us on Facebook at Jack Miller Down to Business or on Twitter at H.Jack Miller 1.
Hello, everyone. This is Jack Miller. I'm here with my main man. How you doing today, buddy?
I'm always doing great, Jack. It's great to be alive.
You making big deals today?
Actually, it was a crazy day, and yeah.
Well, you're a hustling, bustling, superpower commercial realtor in Miami Beach. So I'm super excited about today's show. You know why? Because usually we have on, what do we have, politicians. They don't talk about real world. They talk about what they want us to hear. We have reality stars who are far from reality. You know, they talk about, I don't know why they should call it unreality stars. They're a lot of fun. But today we have a great guest on who's going to talk about making money. And I think his industry, first of all, he's one of the top crowdfunding and lawyers in the country. We're really lucky to have him. He's going to talk about really how crowdfunding and the wave of raising money and investing money on the internet has opened the doors for both investors to invest in deals they normally wouldn't invest in, and developers and sponsors of real estate deals and other deals to get investors they wouldn't get in. So I think he's more of the real world than we ever have on.
Well, that's great. I love crowdfunding. It's definitely not the wave of the future. It's the wave of the right now. It's definitely shaping business. It's shaping politics. It's shaping a lot of different things, and it's certainly shaping our industry, real estate. So I'm excited.
It's exciting, and I think the government's done a good job with this. Usually I rail on the government. But anyway, we have Tony Zeoli on the phone. Tony, you with us?
I am, and thank you for the introduction. It might be the first time anyone's ever said a lawyer is better to talk to than a reality star. So that's, that's new for me.
Well, you know what? We've had a good amount of reality stars or Bravo celebrities, whatever they call them, and I must say they're always a lot of fun. We always laugh. And I watch reality, but they're really far from reality. And
Agreed.
What I like about you, and I don't say your industry, you're a securities lawyer, and I'm going to ask you to tell about yourself in a minute, but it's really changed the way business operates in terms of raising capital and investing in capital that hasn't been done in, I'm going to say 50, 100 years. So with that, why don't you tell the audience what you do, give everyone a little background on crowdfunding, and let's just jump right into it. Let's talk about how to make some money.
Absolutely. I am a partner with Freeborn & Peters out here in Chicago, Illinois. I've been in practice probably over around 12 years, and my practice includes anything from, commercial transactions, all aspects of real estate, and securities laws, which is all kind of lends itself into this new crowdfunding industry, which is why it's such a passion of mine, because rarely do all areas of law intersect like it does with crowdfunding. And crowdfunding is really, it's not a new element per se. It's just a fancy new shiny term that people use, but it is providing new access to investments, both on the investor side, new opportunities to invest in, and from the business side, new ways to find capital for your business. So it's really, like Todd said, it's the right now, but it's going to be the future of how companies are funded from now on.
So crowdfunding, is that where, because it's really investing, is that where sort of the power of the internet has met with the capital markets, where you don't need a broker anymore, you can just put your product on the internet? And if you could talk about how the crowdfunding has come into modern times as a result of the Jobs Act, and just a little background so I and everyone understands it.
Absolutely. I mean, the term crowdfunding kind of encompasses a lot today, so, just saying crowdfunding kind of really doesn't define it. You're right. There are two aspects. There's the crowdfunding that most people are familiar with, which is either donation-based, where people are giving money for a cause, or rewards-based, where people are giving money to try and get an idea off the ground, like a Kickstarter or an Indiegogo. And then there are the types of crowdfunding that come out of the Jobs Act, which is really investing. It's crowd investing. It's people being able to give their money in exchange for, a piece of the company, or, a debt that the company has to pay back, that kind of thing. We're actually putting in money to make money as opposed to just getting an idea off the ground. I think that's that's the most unique part of crowdfunding, particularly, what's coming out of the Jobs Act, is the ability for people to be involved with startup companies and actually get in on the ground floor of the next Facebook and the next Groupon and the next whatever it is, and, have the opportunity to ride that wave, which they've just never had the ability to do in all of the history of securities laws.
So from an investor's point of view, or, just a regular guy, he can buy a piece of a company or a real estate project, a shopping center, an apartment building, or a franchise by just going on the internet, identifying it. Clearly, he has to do his due diligence and know all the risks that would normally do. But the way I see it, and tell me if it's the right or wrong way to look at it, is he can put up a small amount of money, whether it be $10,000, $100,000, that he wouldn't normally be able to get into a deal like that. Usually it's reserved for the country club type and things of that nature. Is that a fair assessment from the investor's point of view?
Absolutely, and I think you can even get lower on the valuation. People can put as little as $1,000 in some instances. They're able to get to deals that basically companies used to have to find funding through angel investors, VCs, people that they physically have to know or be able to get in touch with. And now they can kind of broaden that reach by putting it on the internet. So now the angels actually have to look for them. The accredited investors that normally never had those opportunities can now find them. So it's opening up the opportunities to people who never could have got it. You're right. It was country club deals. It was people who know other people that kind of got introduced that way. That's the way you used to invest in these companies, these small, what are called privately held companies. Even Airbnb is a privately held company. So it's who you know in those instances. Now they're broadening that range by just putting these opportunities on the internet where every day people can do it. In some instances, everyday people, but a lot more people can do it now than ever could before. And eventually it will be everyday people. Anybody should be able to invest eventually.
And you could find these as an investor by just either going directly to the company or going through these websites that are called portals and eyeballing, 4 or 5 and comparing them, correct?
Yeah, and there's actually even more. Now there are so many portals out there that there are actually these aggregator sites where you're going to be able to log on, and they're linked to 10 or 12 portals. So all of the opportunities are going to be in one place as opposed to being on 5 or 6 portals, or you're having to go to each one.
So this is really affecting everything. Todd, for example, sells real estate at Marcus & Millichap in Miami, commercial real estate, and this is greatly affecting the commercial world because I would.
Absolutely.
So, Todd, how do you see that on a day-to-day basis, or does it affect your business out of curiosity?
Well, it's starting to in pockets, and frankly, there's some players out there who do not so much crowdfunding, but things that are sort of peripheral to it that are certainly eating into market share and sort of coming into the forefront. But there are, every deal has room for, people who do what we do. And frankly, given the regular absence at this stage of and I wanted to ask about this, someone like me who, is an expert really in commercial real estate and underwriting, it's important to have someone there to vet a deal for someone who's looking for it and to have, a second or third pair of eyeballs to sort of make sure that what is being represented is in fact, what is being sold to the average investor. Isn't that true?
Tony,
absolutely. Go ahead. Sorry.
No, I was just going to ask you: do the portals do any vetting or kind of due diligence on these offerings?
Yeah, and that's kind of well, that's a good question in general, but that's kind of what people's biggest issue is, especially with the real estate. Is there somebody looking at the projects? There's so many more eyes right now that are on these projects than in the history of other deals. Let's say in the past when you used to do these country club deals, it was a developer going to a couple angel investors, and they would sit in a room and they would hand out documents and say, this is the deal. And there may be 2 or 3 sets of eyes looking at it. Now you have the portals who either if they're acting as a broker-dealer, then they have an affirmative obligation to vet the deal and due diligence. If they're not acting as a broker-dealer, as a registered broker-dealer, they're doing that out of sheer reputation. So they're not they still have skin in the game because they don't want to put up bad deals. Their portals exist based on reputation. So whether or not they're formally obligated to do so, they're looking at the deals. They may not be granularly looking at the deals, but they are looking at them to make sure that they pass smell tests, etc. Then when they get on the net, I mean, you have hundreds of eyes looking at them, thousands of eyes. Who knows how many is actually looking at them and poking holes in them. That's why the crowd has actually been so good at doing the fraud. I mean, going back to your Bravo reality TV show, I mean, the reason why those people have so much drama, get into so much trouble, either legally or, divorce-wise, is because they have millions of eyes watching them. It's not a normal person doing it, or they could probably get away with it. It's doing it in front of 1,000 people. You're doing it in front of the crowd where you actually have to get vetted, and they poke holes in it. That's why if you look at the UK market, that's probably about 3 years ahead of us in terms of all crowdfunding. There's almost non-existent levels of fraud because the crowd has been so good at finding out this information that it's almost easier for people to commit frauds on a private basis than it is this way.
Through the crowdfunding. Now, the crowdfunding is, just to be clear, it could be a combination of, or it could be anyone of buying real estate participating, but it could also be, and I want you to, this is really a question for you, Tony, can it be, I think, and I know it can, or I think it can, it could be on the debt side, lending money, and it could be on starting a business as well.
Yeah, the debt side is usually the safest and easiest to sell because for people to understand, I mean, you're lending money and you expect to get it back with interest over a set amount of time. So there's very, specific things people can understand. There's also equity, and equity works very well in real estate because usually with a real estate project there is an exit, a timeline. We're going to build this and we're going to sell it, or we're going to hold it for 5 years or 10 years. There's a set amount. Then you go on to the more esoteric lines of equity, startups, business, the next tech app. Then I invest in equity, and who knows how long I hold it for, who knows what the potential upside is on it. So there's any of a range of things that people can invest in and timeline depending on their investment preferences. Some do, the short-term debt, 12 months, 18 months, and then also put a little bit on the long-term equity, definite. So a huge array of different investment types that crowdfunding works for.
Now, famously...
I mean, from the real estate side, oh, go ahead, sorry.
That's okay. Famously, one of the earliest, I guess, known crowdfunding projects is the Empire State Building. And, my question is...
Actually, before that, the Statue of Liberty.
The Statue of Liberty? What's the background on that? It's pretty interesting.
Statue of Liberty, we got the thing for free. We got the statue itself for free, but we couldn't afford the base. So they had to go solicit investors, or not investors, but more donations from wealthy individuals to put the base on it. So that was one of the first crowdfunding campaigns.
That's pretty cool.
So from that time period when the infrastructure of Manhattan as we know it in New York City was built, what was sort of the time lapse to get to where we are? I mean, I know the internet helps a lot, but is it the regulatory environment really that's been changing that's allowed this to come to the forefront? I mean, what do you sort of put your finger on? Obviously the internet probably being the number one catalyst.
No, it's absolutely the regulatory agency. The SEC has not allowed, in the past 80 years, we've never had the ability to what's called generally solicit, which means, make offers to anybody, publicly advertise, basically do a public offering, even though it's not considered a public offering. It was always prohibited from generally soliciting, so you had to know the person. You had to have some substantial relationship with the person. You had to have some type of real substantive relationship with the person before you could make an offer for them to invest in these private companies. The intent was that they were supposedly, they were supposed to be watching out for everybody and then making sure that people really knew what they were getting involved in. It didn't really stop Bernie Madoff. He had substantive relationships with a bunch of people, and that didn't really stop the fraud on that end. So it's not really a plausible argument. Now that the Jobs Act has broken that up with, what's called Title II offerings, which are 506C, legal terms, it just means that they can now put these types of private offerings on the internet for people to invest in. So now they're able to generally solicit investments in these private offerings. So that's what's broken the mold, that's been existing for 80 years.
Tony, we got to take a quick commercial break, but before we do, can you give out your contact site, and also if you can give out I know you have a blog at crowdfundinglegalhub.com. Maybe just give out your site, because I know there's a lot of people who want more information from you.
Yeah, I do. You're right. It's crowdfundinglegalhub.com. I know it's a weird name, but it's it's a legal site. And then I am Freeborn and Peter, so it's www.freeborn.com. You can find me at.
Or someone could just Google your name, Anthony J. Zeoli, Zeoli, and you're all over the place. YouTube everywhere.
Yeah, I'm also at AJZeoli at twitter.com.
Gotcha.
Twitter.
Okay, stay with us for about 2.5 minutes. We'll be right back after these commercials.
Don't turn that dial. We will be right back.
Are you tired of dealing with unreliable banks and brokers who charge upfront fees and never deliver on their promises? You don't have to. Gelt Financial Corporation has been in business since 1989 and offers a stated income loan program for non-owner-occupied residential and commercial real estate investors. No tax returns required. What are you waiting for? Call Gelt Financial right now at 561-221-0900. Again, that's 561-221-0900. 561-221-0900.
Did you invest in a non-liquid real estate partnership? Do you want and need liquidity? There's finally an answer. Quick Liquidity is a direct buyer of real estate minority interest and tenants in common investments across the country. To find out if we would buy your non-liquid investment, call us at 561-221-0881 or visit us at quickliquidity.com. That's quickliquidity.com.
Welcome back to It's Down to Business with Jack Miller. Follow us on Facebook at Jack Miller Down to Business or on Twitter at HJackMiller1.
Hello, everyone. This is Jack Miller here with my main man, Todd Cohen, and we got a third main man, Tony Zeoli, today. Mr. Crowdfunding. He is one of the experts. I think, Tony, you're one of the top 2 or 3 crowdfunding attorneys in the country. How's that? I'm impressed.
That is true.
No, it is.
That's just because of a lack of crowdfunding attorneys, but no, it's a passion of mine.
I hear it's because of your talent, not because of lack of. It's because of your talent. I'm giving you the credit. So we were talking about the origins, the basis of it. Tony, I want to ask you a question. What's going to happen? Eventually, the real estate market. This started about because of the economic crisis and the Jobs Act met the internet at an intersection. But eventually, the real estate market's going to bust, or I don't want to say bust again. You'll have a bubble. A couple of these crowdfunding deals will go bad. What do you think will happen in 3 years, 5 years when everyone realizes this is not easy money and projections are just that, projections, and there's going to be inevitably some losses? So the question really is, what do you think, how that will affect the industry, and what should investors be on the lookout for when investing in a crowdfunding deal?
Well, that's a really good question. Let me start with the second part of that question first. Investors, should look out for things that seem too good to be true. The rule still stands. If it looks too good to be true, it is too good to be true. If you see these ridiculous hockey puck type of upward sloping, returns where people are claiming 25, 30% returns, you should be taking that with a grain of salt. You really should. I mean, don't expect it because you're not going to see it. Be lucky to get anywhere on average between 7 and 12% on equity or debt. That's usually what the standard is for this market. If the market does downturn and the real estate does, take another lapse, I think you're just going to see, I don't think you're going to ever stop real estate investment. I think you're going to see a calming down the same way you did with any other real estate turn. Real estate never goes away. People slow down a little bit in investing in it and get a little bit more cautious, and they become more realistic on their returns and what they expect. But I don't think you're going to see anything go, people just totally walk away from this investment class, because that never ever happens on a real estate basis. In terms of, crowdfunding as an instrument, I think you've seen kind of that shake up in the UK. Like I said, they're about 3 years ahead of us, where there was this kind of wild west of really high projected returns, and then, some of these investments failed. Not fraudulent, they just were bad investments, and, there was a reason why they're risky investments. The risk didn't pay off in those instances. But then, the market itself kind of calmed down on the expected returns, and they took it with it. They went with it, and they went with the flow. So I don't think the investor class took that much of a hit when it actually did downturn a little bit. So I think, as long as they understand that it's a risky investment, that they're going to be okay.
Got it. 2 questions. First of all, the exchange laws, like a 1031 exchange, how does that fit into crowdfunding if you take like a small position in a deal? Are you still able to do a like-kind exchange?
If it's set up correctly. I know that Fundrise or Realty Mogul, one of those was doing some type of 1031 specific type of transactions where they're set up correctly. You can drop down and this is not my particular area of expertise, but you can drop down your investment in your current property and sell it off in the right way so that it qualifies as a like-kind exchange. There are ways to do it, and there are certain funds that do it. I don't think they had much success with it, not because it was a bad play, but because we're still in the market building, market recognition type of stage where we're getting people to understand the market, let alone complexities such as that.
My second question is, do you see a time where sort of the shares involved in some of these deals get so small that like day trading would become like a phenomenon in this type of market as well, like it is in the stock market?
I don't think you're going to see day trading because you're not going to see that fast of trades. The reason why the stock market exists that way is there are at least some type of ongoing financial requirements that provide some basis for valuing an investment. On the private place, that's been one of the hassles that stopped the secondary market or making it harder for a secondary market is there's just not a lot of ongoing financial requirements to help price those in the secondary market. Really what I'm saying is nobody knows what it's worth for the most part because nobody's getting information. There's not ongoing sensitive information. At least with the newer standards, these newer types of products that are coming out, they are issuing financial statements in a lot of instances, so you're starting to better value those secondary investments, and you're going to see them become more liquid. I don't think you're going to see them on a day trading type of market, though, because they're just not going to be traded that quick. There's not going to be that much of a supply and demand for it to be that. There will be people taking advantage of the arbitrage, trying to buy things at less than they're actually valued because people need liquidity, etc., that kind of thing.
By the way, we're doing that through Quick Liquidity, one of our sponsors and a company I'm involved with. We're buying, Reg D crowdfunding shares on the secondary market because there is a lack of liquidity on it. So we present the liquidity option for some people. Tony, let me ask you another question from the investor, from the sponsor or the general partner's point of view. I think that crowdfunding has greatly brought down the cost to raise capital because before, if I wanted to raise capital and I was a sponsor, if I had to pay a broker dealer like a lot of the REITs do, you had to pay them sometimes 5, 6, 7, 8, 9%, and then all the costs, it could cost 10, 12% to raise the capital. And I think, and I want your comment on it, that now with the crowdfunding portals, it's a much more efficient market where it's costing a fraction of that because that money ultimately was coming out of the deals.
Yes, and they're coming out of investor pockets, actually. I mean, one, you're cutting out a few of the middlemen that were doing that. I mean, not to say that the fees aren't around, 5, 6, 7, 9% to get it through the portal, but you cut out a lot of the extra fees. You cut out a lot of the, the 100-page private placement memorandum that costs $30,000, $40,000. A lot of the ancillary fees that are above the broker fees, the middlemen broker fees, the introducer broker fees, those kind of things. You're cutting a lot of those extra fees. So while it is, 7, 9%, it's a clean 7, 9%, and the majority of the money goes into the deal as much as possible.
Is that what you're finding on average? It's costing the general partner to raise the capital on a crowdfunding deal?
Anywhere from probably 5 to 8%, I'd average, all in. It depends on the type of deal, the type of exemption you're using. If you're using Reg A Plus, it's going to be. It depends on how much you're raising, but it could be a $200,000 fee to get it to market, but you also can raise up to $50 million that way, and it's a publicly traded thing.
Gotcha.
Instrument. So it's a little bit different, but different vehicles. I would say just by the private placement side, the portals that you're usually seeing, on average, anywhere between 5 and 8%.
Gotcha. Now, if you could talk to address the difference between federal law in this world and state law, because I get a little fuzzy on it, and I suspect a lot of people do, and I know there's a difference.
There is. The federal level rules right now, the ones that you're seeing popping up, the investment portals that have been popping up over the last couple of years exist for basically was the first part of the job, not the first part, it was called Title II of the Jobs Act, that basically took the private placements you've always done, these country club deals, and just allowed them to be put on the internet, allowed people to see them. The only people that can invest in them are still accredited investors, people who make over $200,000 a year or have over $1 million of net worth without their residence, without including their primary residence. So, rich people were the people that can invest in it. That's still the same case today, but you have other options. You have what, as of the end, mid of last year, registered offering that is kind of what's a mini IPO. You can take your company to market, or you can take, Fundrise is doing an e-REIT version of it for real estate. So you can take this, you register it with the SEC, it becomes a registered security for federal through the federal process. It's a registered security which can be sold to accredited and non-accredited investors. So everyday Joe can buy this the same way they can buy a share of Microsoft or they can buy anything else. That's the federal level rule. So there's one more on the federal landscape. There's what's called Title III. This came out last year. This is, a company can raise $1 million if they go through the process of, this kind of heavy registration process with the SEC. I don't particularly think it's a very useful product right now at the $1 million cap because I think it costs too much and it's too much of a hassle to register. But at the end of it, you can sell to accredited, non-accredited investors. That was actually supposed to be done maybe 3 years ago. It took so long to do it that the majority of the states, including Florida, Illinois, Wisconsin, Indiana, Michigan, there's about 30 of them that actually started to create their own laws to do what's called intrastate crowdfunding. Basically, it's a public offering that occurs entirely within a state. So for my state, I wrote the law for my state, actually, for Illinois. An Illinois company can raise up to $4 million from Illinois residents, whether they're accredited or non-accredited. So they can just go and do this public offering, and they can sell it to anybody as long as they're Illinois residents. I mean, there's a little more to it in terms of what you can say and how you can say it, but that's basically it. It exists under an exemption from federal law that basically says, what happens within a state can be governed by that state. So that's the state-level versions. And Florida has one, too, but they can only raise $1 million.
Now, the number, I think that the crowdfunding has done more for the economy than really anything in the past number of years, and I think it's a great example of how deregulation has helped out. Government, I believe that's one of the secrets of the country is the government should step out of the way and let business do what it does best, and it seems crowdfunding is a good example of that. Could you talk about the growth in this industry? Because I've read some numbers, and I don't remember what they are now, but the growth that people who are buying into crowdfunding deals, or what I call the old Reg D deals, has just been growing at an unbelievable pace.
Yeah, I mean, I think the real estate side alone is one of the biggest players. I think they started off at like maybe $100 million at the end of 2013, maybe $1 billion as of the end of 2014, and they're projected at $2.3 billion as of the end of 2015. They're expected to keep doubling year over year for at least the next 5 years, and they represent, I believe, about 10% of the overall kind of investment crowdfunding market. So you can imagine where that goes. Year over year, this thing is doubled in growth that people invest in. And it is more a matter of knowledge than anything else. People knowing that this asset class even exists. It's been hugely successful in terms of just being an asset class that people want to invest in. Because mutual funds, all this stuff that you want to invest in, they're getting marginal returns. They're not even beating the stock market. They're not. A lot of times they're averaging under what the average stock market is doing. And this is just another asset class that people like, people who are younger that have disposable income, that have an asset that they just want to invest in. Maybe some not much self-managed because they don't want to do that, but it's an asset class where they have some real potential for higher returns. People who take risk, younger people who have disposable income want to take risk, and they've never had an asset class like this where they can do that.
So someone can invest in a Walgreens or someone can invest in a mobile home park across the board. They can invest in really any type of real estate or business or debt instrument they want to.
Yeah, and the ability to put in small chunks across a broader diversification, allows them to average, which they're averaging, at between 7 and 12% return.
What do you think, out of curiosity, the average investor is investing in a vehicle, a crowdfunding vehicle?
I believe the last report I saw was anywhere between $10,000 and $20,000.
Gotcha. So it's, I hear you. So it's
maybe not in a particular vehicle, but across the board.
Understand. So it's a lot.
5,000 here and 5,000 here.
It's a lot less than where someone needed, in the old days, $250,000 to put in a Reg D or whatever the minimum investment. It opens it up to a lot more people. Tony, we only have a couple minutes left. What didn't we cover that the public should know about crowdfunding?
A couple things. Like I said, let's get back to it. If it sounds too good to be true, it is too good to be true. If you're investing in a crowdfunding portal, do a little research on the portal itself. Some of these portals pop up, and we'd rather not have them. They're just fly-by-night portals. Not to say that they're bad people. They're not experienced. Like that guy that appeared on Shark Tank, if you saw it, about real estate crowdfunding. The guy knew absolutely nothing about crowdfunding and made it look like a horrible investment. Had he been anybody in the industry that could have answered those questions, it would have looked like a much more viable instrument. So do research on the portal as well as the investment. And then, it's a viable source for those looking to raise funds. Look to Interstate. Look to these resources. It's a viable new option for you to raise funds and for investors. A fantastic new world of investment.
Great. You've been fantastic. I really appreciate your time. Could you give out your contact information again for everyone?
Yeah. I am with Freeborn and Peters. That's www.freeborn.com, FREEBORN.com. And I have a crowdfunding blog at crowdfundinglegalhub.com. And I am on Twitter at AJZeoli, Zeoli.
Tony, I appreciate your time today. You've been fantastic. I think our listeners are really going to love this. Everyone to go to a few portals and just sign up, because a lot of them have like newsletters and they'll send you their weekly kind of investment opportunities, and by doing that you'll learn a lot. Tony, thank you very much. Todd, another good show. Everyone stay with us. We'll see you next week. Thanks, guys.
We hope you enjoyed our show. Don't forget to tune in next Thursday at 3 o'clock on 880 The Biz. Check us out on hjackmiller.com. Follow us on Facebook at Jack Miller Down to Business or on Twitter at HJackMiller1.
You got to turn